Hello, everyone. Happy Thursday. On the call today is Jennifer Rader, Loan Originator with AmCap Home Loans, and myself, Rachel Droll Eskelund. I'm a real estate agent with JLA Realty. Today, we're going to talk about refinancing your home. What is refinancing? How does it work? When would be considered a good time to refinance? And what does it all entail? So, Jennifer, what is refinancing?
Great question, Rachel. So refinancing is when you have a home and you have a mortgage on it currently, and you wish to refinance it or remortgage it for a slew of different reasons. So you're going to replace the existing loan with a brand new loan.
Okay, that makes sense. What are some reasons a person would refinance their home?
There are several reasons. We'll talk about the most popular ones first.
Okay.
The main reason most people refinance is to get a lower interest rate.
Okay, so that's where the term marry the house, date the rate comes into play, right?
Exactly. So a lot of people, especially now with rates where they are, they're like, oh, I don't want to buy because I don't want to pay that interest rate. Well, what our philosophy is, get the house you want when you want it. And even though the rate is a 15 or 20 or 30-year term, it is really not a permanent loan because you can refinance it at any time in most cases. Especially in our state, there are no prepayment penalties. So there's no requirement that you have to stay in a loan a certain amount of time. So you could refinance it to get a lower interest rate. So get the house you want and just know that you can refinance later to get the payment a little bit closer to what you'd prefer to have.
Right, which I'm pretty sure we're going to be seeing a lot more of people refinancing in the upcoming months as the interest rates start to drop, right?
Yes, that's what we're expecting with people buying this year with the rates where they are. We're expecting once the rates settle down again, in the upcoming future that they'll, if they have enough equity to do it, they'll refinance those loans into lower rates.
Perfect. Okay. What are some other reasons?
Another good reason to refinance. Oh, sorry. Another good reason would be would be to change the term. So either shorten the loan term or lengthen the loan term. So most people think, oh, I'm going to change it from a 30 to a 15 or a 30 to a 20. A lot of people don't even know there's a 20-year option, but there is. But most people think, oh, I'm going to, make my payments higher, pay it off sooner by going down to a 15, which is a great option. That's actually what I did several years ago. So that way I could be done with my mortgage when my youngest kid was graduating. On the flip side, you could change it from a shorter term to a longer term. So let's say your situation has changed. Now maybe you have a couple kids that, kids are expensive, or, you have a job change and you're not making as much money, and that 15-year payment is just making things a little too tight. You could refinance out of that 15-year term and go into a 20 or 30-year term, extend it out, and have lower monthly payments.
Perfect. And then I think there's also a cash out refinance, if I'm not mistaken. You want to explain a little bit about that?
There sure is. Yep. So a cash out refinance is the same general idea. You're refinancing, so you're replacing your existing loan with a new loan. But in this case, instead of just borrowing what you already owe, you're going to borrow more than what you currently owe and do what's called cash out, which means you're dipping into the equity in your house and pulling some of that money out.
Okay.
So for numbers,
if somebody were to do that, is that money taxed at all?
it is not taxed because you're dipping into the equity of your home. It's your own home, it's your own equity, it's your own asset. So there aren't capital gains or anything like that. There's no taxes, there's no implications like that on it. But for numbers purposes, to kind of think about it, let's just pretend someone owed 200,000 on their home and it was worth, say, 400.
Okay.
If they want to do home improvements, they want to pay off higher interest debt like credit cards, they want to invest some money into high yield funds, something like that would prompt a cash out refinance. So instead of borrowing just the 200 to pay off the loan, they could say borrow 250 or 260 and then take that extra money and use it elsewhere. And then now you have a new loan for the 250 or the 260 instead of the 200.
And actually at a lower interest rate, right? Like,
yeah, if rates are better, then it's lower.
22%, right? If it's a credit card or something like that. That makes a lot of sense.
Yes, exactly. We see it a lot, even for people who say are in maybe the 3s or 4s right now. I have some people that are refinancing into the 5s and 6s because it's still less than what they're paying off.
Yep.
So like you said, with the higher limit or the higher rates on credit cards and stuff, let's get that money done, because if you start making those minimum payments on credit cards, you're never going to pay that card off. Whereas
Absolutely.
if you put it into the loan and you have a fixed date to pay it off, it's at a much lower rate, is much better.
Great alternative. Absolutely. So what about divorce?
Okay, we have that a lot too, unfortunately. There is only one way to get someone off of the mortgage. And so in a divorce situation, if you have a husband and wife that are on the loan and they get divorced, one wants to keep the house and one wants to go off and buy a new house, the only way to remove them is to refinance. You cannot remove someone without refinancing. If they were originally on that loan, they are obligated to that loan until it's refinanced. So in that case, yes, they would have to do a refinance. We would take the other spouse off. They'd have to, sign some paperwork. Both people sign paperwork, but they sign paperwork releasing the lien and saying they have no more interest in the home. And typically it's also addressed in the divorce decree that, whatever the husband or the wife is getting the home and the other person is releasing everything on the home.
Okay, and then the spouse that's being dropped off of the mortgage, does it affect their credit at all?
I wouldn't say it hurts their credit, but it will affect their credit because now you're going from having an very large open installment loan to having a closed, paid off installment loan,
Okay.
which in the long run is a good thing. In the short run, it actually will lower their score a bit because anytime you pay off an installment loan, either like a car or a house or something, when you pay those off at the end, they do lower your score a bit because they are counted as a smaller percentage of your credit score once it's closed versus once it's open. So you'll have a short-term effect, but not a long-term. Long-term, it will be a good thing.
Makes sense. Great info to have, honestly, especially for someone who's going through that process.
Yeah. We try to make it as stress-free as possible because divorce is already so stressful. So we try to make it as easy as possible in a divorce.
Yep. What other, is there anything else on the list of why someone would refinance?
Oh, let me think. Maybe to add someone on. That doesn't happen as often. A lot of people who maybe were single when they bought their house, they would sometimes want to put their new spouse on. We don't see that hardly ever, but that is something you could do.
Okay.
I can't think of any other reasons. I think that would probably be about it. The main reasons, actually.
Awesome. And then how does PMI work and in regards to eliminating it?
Oh, duh, that's the last reason. The last major reason. I forgot about the PMI. Yes. So let's say when you got your house initially, you put less than 20% down on a conventional loan, you're going to have monthly PMI, which is just an extra part of that payment. So you have your principal and interest, your taxes, your insurance, and then that monthly PMI. PMI is simply an insurance policy that protects the lender if you were to default on the loan. And it's put on loans when you put less than 20% down because lenders feel like you don't really have enough skin in the game to maybe not walk away. It's easy to foreclose because I didn't put much money down. Big deal, I lose my 5% down payment. So it's an insurance policy that's added too, and the borrower pays for that. So once you have enough equity, you could refinance and eliminate the PMI because now you have 20% equity in the home. Even though you didn't have it when you bought the house, maybe 5-10 years later, you have the equity, you could refinance, eliminate that PMI, and now you have a payment with just the principal and interest, taxes, and insurance.
Okay, that's great information. So I have heard a lot of questions when people are refinancing. Is there any way that they're able to eliminate an appraisal? And if so, under what circumstances would that fall under?
Yes. And most people don't even know that exists. We saw it a lot in 2020, not as much last year. We've seen a few times this year. The way, and there's really not a magic formula. I've seen appraisals be waived on files that I wouldn't have expected them to be waived on. And I've seen them waived on ones that I'm like, wait, what? How is that even waived? Most of the time when we see the appraisal requirement waived, and just so you guys know, an appraisal is something, it's a third party that goes out to tell us how much the house is worth. And 99.9% of the time, or it used to be 100% of the time, an appraisal was always required because we need to know how much it's worth to know how much that person can borrow, right? Purchases and refinances, of course. Well, what we were seeing a lot of is people who were refinancing, they either, and really I saw in this combination, people with good credit, like really high credit scores, people with some reserves, which is extra money in the bank or savings or, like investment accounts, things like that, and or a lot of equity. And so what happens is when we plug their information into our system, the system, we plug the actual address in there, and the system comes back and does its own analysis of the value of that home. If the system comes back and says, hey, we think it's worth X amount, and they're borrowing, an amount that works with that amount, an appraisal could be waived, which saves that borrower, anywhere from $600 to $800 to even more, depending on what the cost is for that particular house.
Wow.
What we don't see it happen on is people who have, lower credit scores, very little equity, things like that, because then that's a kind of more of a marginal deal, and they're going to want that appraisal to make sure that we're not going over what they should be borrowing.
Right. That's something that I learned new today too. So that's learn something new every day, right?
That's the goal.
Right. All right. So another question that gets frequently asked when people are refinancing their homes is there closing cost? And if there is that out of pocket?
Yes and no.
Okay.
So let's address the first part of the question first. Yes, there are closing costs, and they're very close to what they were when you purchased the house. So you're going to still have all the state fees. You're still going to have title work. You may have an appraisal, maybe not. You'll have all that type of stuff. However, you will get discounts on certain things. So if the appraisal is waived, of course, you wouldn't have the appraisal. The title work is discounted based on, I think, the first 7 years after the purchase. It's a prorated discount up to that amount of time. So you get a discount on the title work, which is one of the highest costs when you purchase. Right. So getting a discount on that is real helpful. And you'll also get a discount for us as a lender. If you purchased your house with us and then you refinance with us, we do not charge the lender fee the second time because you're an existing client for us. So you'll get that discount as well. In terms of, what was the second part of your question?
If it comes up
as out of pocket. It depends. It can be out of pocket. So if you want to pay it out of pocket, you can. Most people elect to just roll it into the loan because just eat up a little bit of equity while you're doing it. So most people prefer that just because they don't want to bring money. They don't want to take that money out of the bank if they don't have to. If you're very tight, let's say it is worth X and you're borrowing, 95% of that, and there is no room to roll in those costs, then they could bring those costs out of the pocket and not have to roll it into the loan itself. So it could be either or.
Okay.
In the cash out situation, it's always rolled in because you're taking cash out anyway. So we just deduct that from how much they're going to get as a payment.
Okay, perfect. And then what is recast, and when would that be a better option versus refinancing?
So a recast is also a term that most people do not know. The general public, I would say, probably doesn't know. I would say people in your field, in my field, your field, some people have heard of it. There are a lot of mortgage loan officers that have never heard of it. They don't know what it is. So it's kind of a really nice tool to be able to tell people. And what a recast is, instead of a refinance, which replaces your existing mortgage with a new one, a recast is keeping your existing loan, but lowering the principal balance and then re-amortizing that new balance over the remaining term. So it works a little bit differently. And the main reason for doing it that way, it's much easier. They still have to qualify, just like they would on a regular loan. Actually, no, I'm sorry. You don't qualify for anything for that because you already have the loan. Sorry, I was thinking of the refinance. So you don't have to requalify for anything. And typically, if there's a fee, it's a very small fee. It's just like an administrative fee just to do the paperwork to get it done. So it's much easier. And for you as the borrower, you don't have to change anything. You're not changing servicers or anything like that. You keep your loan exactly the way it is. And the main reason for doing that would be, well, two main reasons. In the kind of the market we're in right now, a lot of people either purchased or refinanced in 20 and 21 when the rates were super low. Maybe you've got a 3% interest rate. You don't want to touch that because who knows if it will ever be back to 3? Probably not, right? So let's keep the low rate. But I've just received, say, a big bonus or an inheritance, or I get a lot of overtime and I've been saving it up over a couple months, or something to do like that. You could keep the loan you have, take that large sum of money put it towards the principal, which you can do. And let's take a step back. You can do that at any time. Any loan right now, government, conventional, anything. If you have an extra principal payment you want to make, you can do that anytime you want. You could do it monthly, you could do it quarterly, you could do it once a year. There are no restrictions on that. But when you do that in a normal time, you don't get a different payment, right? Your payment stays the same. You're just chipping away at the interest.
Right.
Right. So you're just saving yourself money over time. Where the recast, when you put in that large amount of money, you're requesting them to re-amortize it for the remaining term, which will lessen that monthly payment. So it lessens that monthly burden while reducing that total loan amount for you.
People need to know more about that.
Yeah, it's a great option. Especially, I think we're going to start seeing more of that in the upcoming years because of how many people purchased and refinanced in 20 and 21, right? The rates are so low. I wouldn't refinance a house that I had at 3%, not unless I had to for some reason, you know. If I could just do the recast, I would rather do that.
Yep, absolutely. Better option for sure. Well, there you have it, everyone. I hope this helped bring light and a better understanding to what refinancing your home means and looks like. If you have questions that we may not have answered or covered today, please reach out to either Jennifer or I. Our information will be in the caption below. We are here to help you. Again, I'm Rachel Droll Eskelund, a real estate agent with JLA Realty. And Jennifer.
And I'm Jennifer Rader with AmCap Home Loans.
And we will see you next time. Thank you.
Thank you.